Let's take a look at IAS 40, our standard on investment property. To begin with, we're going to take a look at our standard on a page as a high-level summary of what we're going to be dealing with within the standard. To start off with, as with most standards, we need to be aware of the fact that we need to deal with classification. In this particular case, classification can be a little bit tricky because investment properties can look like or seem like inventory, or more obviously or more generally your property, plant and equipment. So we need to be aware that there's a lot more complexity to our classification. Our initial recognition and measurement. Our initial recognition shares very much the same concept as our assets in general, as our PPE, and yet obviously there are differences that makes it investment property rather than PPE. Our initial measurement, we have our costs that include our directly attributable costs or our directly attributable transaction costs. We have replacements of parts of our property if there's a possibility that some of those parts are derecognized. If there's a component approach, we can derecognize and then recognize replacement parts. And operating losses are excluded, or operating losses do not get taken into account in part of the costs before planned occupancy is achieved. Our subsequent measurements, once this has been brought onto the books, subsequent measurement has an accounting policy choice, either cost or fair value. In terms of the cost, we go back to our PPE standard, our IAS 16. In terms of our treatment there, we have our depreciation, we test for impairment, and in the notes, the difference to IAS 16 is that although you may account for your investment property at cost, you do need to disclose the fair value in terms of your financial statements. With the fair value model, the fair value in an active market is used and your gains and losses go to profit and loss. So a gain on your fair value or a loss on your fair value adjustment is going to go to profit and loss, not a revaluation surplus in terms of a PPE. There will be no depreciation on the fair value model. When we look at the possibilities in terms of derecognition, there are two components or two categories that we would split this into. Either we derecognize investment property as a result of a direct disposal, or it has been permanently withdrawn from use, or we may derecognize investment property because there has been a change in use. It has been used as investment property, but at a certain point in time, we are transferring that, we're changing the intention, and we are now going to be using it as property, plant and equipment or inventory. So there's a possibility we may derecognize for disposals or for transfers. We will obviously be going through these in more detail as we go through the rest of the process, as we go through the rest of the lectures.